Welcome back to the deep dive. Today, we're digging into the third quarter 2025 results for Rowe Price Group.
Yeah, and this is more than just numbers on a page.
Absolutely. It's really a snapshot of a huge established player trying to pivot pretty quickly, actually, in what's still a really challenging market. They hit a record high in assets under management, which sounds great, but that number, it hides some real underlying issues.
That's exactly it. And our job today is to kind of cut through all the noise from the earnings call, the filings, and really give you the core story.
Right.
We need to understand how they can have record AUM, but still see clients pulling money out. We'll look at their financial health, see how they're shifting products, especially into alternatives and, interestingly, digital assets.
And the big one, right? The struggle to generate alpha, that active management edge, when the market's basically being driven by just a few giant stocks.
Exactly. That's the fundamental challenge we need to unpack.
Okay, let's start with those top-line figures then. End of Q3, assets under management, AUM, hit a new record. What was it? $1.77 trillion.
It's a huge number.
Yeah, and revenues look pretty solid, too. Total adjusted revenues, $1.9 billion, up almost 10% from Q2. Adjusted EPS came in strong at $2.81. So you'd think, wow, great quarter, money must be pouring in.
You would think that, wouldn't you?
What?
But that's not quite the picture. That record AUM, it needs some serious context.
Yeah, okay.
The firm actually saw $7.9 billion in net outflows for the quarter. Net outflow.
Wait, $7.9 billion out? How did that square with a record AUM? That feels like a complete contradiction.
It does, but it was almost all about the market just going up.
Yeah.
You had substantial market appreciation plus investment income that added, let me check, $89.1 billion to their assets.
Wow, okay, so the market basically just lifted everything and completely swamped the outflows.
Precisely. Plus, there was a small definitional change. Starting July 1st, they began including these managed account model delivery assets in their main AUM figure. That added another $9.2 billion right there.
Okay, can you quickly explain what those model delivery assets are? That term pops up a lot now.
Sure. So basically, T. Rowe provides the investment model, the asset allocation, the list of stocks or bonds, but the actual client money stays on someone else's platform. Think a big brokerage firm or an independent advisor's custodian.
Ah, got it. So T. Rowe gets paid for the model advice but doesn't hold the assets directly.
Exactly. It's a way to scale their advice business. But, important point, including that $9.2 billion is more of a reporting adjustment. It's not like new money flowing directly into their traditional mutual funds.
Okay, so the big AUM number is really driven by the market being up and this reporting tweak, not necessarily new clients rushing in.
That's the takeaway on volume.
Let's talk price then, because this seems to be where the real pressure is, the effective fee rate, the EFR. What happened there in Q3?
Yeah, continued pressure is the story. The annualized EFR dipped again, down to 39.1 basis points. That's from 39.6 just the quarter before.
Doesn't sound like much, half a basis point, but on almost $1.8 trillion.
Oh, it adds up fast. That tiny drop translates into potentially tens of millions less in annual revenue. It's significant.
And what's causing that slide? Is it just fees going down everywhere?
It's largely structural. It's this ongoing shift, industry-wide really, towards lower-cost options. For T. Rowe, they're seeing money leave their higher-fee products, like their classic U.S. equity funds.
Their bread and butter, historically.
Exactly. And the areas where they are seeing growth, like in target date trusts or their blend series, those just naturally have lower fees. So they're managing more money technically, but getting paid less per dollar on average.
Which puts even more pressure on performance and, I guess, efficiency, which we'll get to.
Precisely. If your fees per dollar are shrinking, you absolutely need to deliver strong performance, especially if you're an active manager claiming you can beat the market.
So let's look at that performance data. It seems like a tale of two cities. Pretty good long-term, but maybe some struggles recently.
That sums it up well. The long-term picture, it still looks solid. Over 3, 5, and 10 years, you've got 50% or more of their funds beating their peer groups.
Okay.
And if you look at it on an asset-weighted basis, which basically tells you how the money in their biggest funds is doing, it's even stronger. Over 10 years, 78% of their fund assets beat the peer group average.
So the long-term story holds up, but breaking it down by asset class, where are things really working and where are the weak spots?
The clear standout is fixed income. Their bond funds are performing very strongly. Across all the time periods they report, over 70% of their fixed income assets are beating their peers. That's impressive.
Okay, solid on the bond side. But what about the target date funds? You mentioned they're seeing inflows there, about $2.6 billion, which is good.
Yeah.
But the short-term performance?
Yeah, that's the mixed bag. Despite those good inflows, only 43% of the target date fund assets managed to beat their peers over the last year.
Ouch. Do they say why?
They were pretty open about it. They pointed to issues with the underlying security selection, specifically within the equity parts of those target date funds.
Ah, which brings us right back to that big challenge, active equity management in this current market. I saw the notes about market concentration. How bad is it, and how is it hitting their style?
It's creating a really difficult backdrop for their traditional approach. Q3 saw strong overall market returns, yes, but those gains were incredibly concentrated in just a few mega-cap growth names. You know the ones.
The handful driving the S&P 500.
Exactly. The leadership was extremely narrow. Management themselves called it a very narrow market.
So if you're T. Rowe, known for, say, quality stocks or maybe finding value, you're just getting left behind.
Pretty much. Their own internal analysis confirmed it. Quality and value factors were the worst performers in Q3. And guess what did best? The riskiest slice of the market.
So fundamentals are out, risk on is in, concentrated at the top. That's tough for traditional stock pickers.
It really is. When the market rewards speculation, or just sheer scale disproportionately, T. Rowe's core philosophy, finding good companies at reasonable prices, struggles to keep pace with the index.
But they're betting this won't last forever, right? They used some history lessons.
They did. They pointed to past periods of extreme concentration, like the Nifty 50 back in the 70s, or the TMT, the tech media telecom bubble in the late 90s.
Okay.
And their point was, historically, after these peaks in concentration break, there tends to follow a very significant alpha generation opportunity for active managers. They believe mean reversion will kick in.
So hang tight, the tide will turn, and our style will work again.
That's the bet.
It's a compelling historical argument, but here's the tough question. If this narrow market lasts another year or two or three, does that future alpha opportunity matter to the clients who are leaving now because of the underperformance, those outflows we talked about?
That is the absolute core dilemma, isn't it? And that's precisely why this strategic pivot we're about to discuss, moving beyond just relying on picking stocks and bonds, and really pushing into alternatives and packaged solutions, is so critical for them.
They can't afford to just wait for the market cycle to turn.
No, they have to build other growth engines right now.
Okay, let's talk about that pivot. This is the really big news. The huge strategic tie-up they announced with Goldman Sachs. This looks like a major play to offer more complex, diversified stuff, mixing public and private markets, especially for retirement and wealth clients.
Yeah, this is clearly the centerpiece of their strategy going forward. It's designed to give them an immediate, significant boost in areas like private markets and advisor platforms where, frankly, they needed to catch up.
So let's break down the four main parts of this deal. They seem to target different needs. First up.
First, and probably the most significant for the retirement market, is this co-branded Target Date Sister Series. Think of it as a new version of their Target Date funds. Expected launch is mid-2026. It'll mix T. Rowe's traditional stocks and bonds with private credit from OCHA, that's the private credit specialist T. Rowe owns, plus other alternative investments from Goldman Sachs.
Interesting. How much alternatives are we talking?
They're saying allocations could get up into the mid to high teens in private alternatives, which is quite substantial for a target date fund. And they stress they aim to do this while keeping fees competitive.
And who's the main advisor on that series, T. Rowe or Goldman?
T. Rowe Price will be the advisor for that target date series, managing the overall mix.
Got it. What's the second piece?
Second is model portfolios, also co-branded, also including alternatives. These seem aimed more at financial advisors using model platforms, and they're moving fast here, planning to be on the first platform before the end of this year, 2025.
Wow, okay. Advisor role flips here.
Yes, for the model portfolios, Goldman Sachs will be the advisor, likely leveraging their strong distribution network with advisors.
Makes sense. Play to strengths. Third area.
Third is multi-asset public-private market solutions. These sound like more customized, maybe more sophisticated strategies. They mentioned two initial ones launching by mid-2026, one focused on public-private equity, another on multi-alternative strategies.
And T. Rowe advises on these.
Correct. T. Rowe is the advisor here. Seems targeted at higher-end wealth management clients.
Okay, and the last piece involves technology, right?
Right. Number 4 is a personalized advice solutions and managed account platform. This is specifically for independent advisors, launching later in the second half of 2026. It combines T. Rowe's investment smarts with Goldman's tech for digital planning and managing accounts.
So a full suite, target date, models, custom solutions, and the tech platform to deliver it. The ambition seems huge. Did they talk about potential asset gathering?
They did. They were careful not to give exact numbers, but management said their goal for AUM generated just from these Goldman initiatives over 3 years is significantly greater than, quote, a couple of $billion.
Okay, so they're clearly betting this partnership will fundamentally shift their growth story and those flow numbers we discussed earlier.
It has to. This is a massive strategic bet.
While that Goldman deal is the headline grabber, they aren't putting all their eggs in one basket, right? They're also pushing hard on other fronts, like ETFs.
Definitely. The ETF business is really humming along for them. It's one of the brighter spots, providing some offset to the pressures on the traditional mutual fund side.
The growth looks pretty strong. ETF AUM hit $19 billion by September 30th, and they pulled in nearly $2 billion in net inflows just in Q3 alone.
Yeah, and context there. They've actually doubled their market share in the active ETF space over the last couple of years. That's quite an achievement in a crowded market.
And they have big plans for more.
Oh, yeah. Very ambitious. They said by the end of 2026, they expect to have ETFs available covering over 3/4 of the Morningstar AUM universe.
Wow. So basically, if there's a major investment category, they plan to have an ETF for it.
That seems to be the strategy. Making sure they have the right product wrapper, the ETF wrapper, available for advisors and investors who prefer it.
Okay, so ETFs are a key growth pillar. What about the newer frontier, digital assets, crypto? Where does T. Rowe stand?
They're making moves there too, cautiously but deliberately. They recently filed for a multi-token crypto ETP ETF. An ETP is an exchange-traded product, similar to an ETF.
A crypto ETF from T. Rowe Price, that feels like a significant step for a traditional manager.
It is, but they emphasize this isn't some sudden jump onto a bandwagon. They've apparently been on an internal digital asset journey, as they called it, since 2022. Building expertise, understanding the plumbing before launching products.
Smart. What's their underlying belief? Why get into crypto at all?
Their multi-asset team sees potential for both operational alpha, using blockchain tech to maybe make things more efficient behind the scenes, and investment alpha.
Investment alpha, meaning they think crypto can actually boost portfolio returns.
Seems so. They mentioned studying its unique characteristics, things like momentum and how it behaves in market extremes, its tail risk. The conclusion seems to be that, over time, digital assets will become a necessary part of diversified client portfolios.
Especially as more institutions get involved, maybe?
That's likely part of the thinking, yeah. Get ready now because it's coming.
Okay, so we have these big investments, the Goldman partnership, building out the ETF suite, exploring digital assets. That all costs money. How are they managing the other side of the ledger? Costs, efficiency.
Yeah, that's crucial. You can't fund all this new stuff without keeping a tight rein on existing expenses. They have a pretty broad expense management program going.
What's the goal?
The stated goal is to keep the growth in controllable expenses down in the low single digits for both 2026 and 2027.
How are they doing that? I saw something about headcount.
Right. Headcount is down 4% since the end of last year, 2024. That follows a workforce reduction they did back in July. That action led to a $28.5 million restructuring charge hitting the books in Q3.
And wasn't there something big coming up with real estate? A huge charge.
Yes, that's a major move, signaling their seriousness about cost. They're shifting strategy from owning buildings to leasing them. As part of that, they're getting rid of 2 buildings on their Owings Mills campus that aren't currently occupied.
And that triggers a cost.
A big one. They flagged a $100 million non-recurring charge related to exiting those buildings, expected to hit in Q4. It's a tangible sign they're rethinking their physical footprint.
So, head count down, getting rid of buildings. Are those savings just flowing through to profit?
Not entirely, and this is key. Management was clear that these cost savings are being deliberately reinvested back into those strategic priorities we've been talking about.
So freeing up cash from the legacy side to fuel the growth stuff, the
Yeah.
solutions, advice tech, AI capabilities.
Exactly. It's about funding the future by optimizing the present.
Okay, makes sense. Let's bring it full circle back to flows then. We know target date did well, fixed income okay, and alternatives, their OSHA unit raised over $6 billion in new commitments, which is strong. But despite those pockets, the overall net flow number was still negative. What's the immediate outlook, say, for Q4?
Yeah, the near-term picture isn't expected to improve much immediately. Management guided that Q4 flows are likely to be weaker at the margin,
Weaker. Why?
mostly due to expected higher redemptions, especially from equities. Think about it. The market, particularly those big cap-weighted indices, had a strong run.
Right, driven by those few mega caps.
So as we get towards year-end, you often see institutions and even retail investors rebalancing. They take some profits off the table from those winning mega cap stocks.
And T. Rowe, maybe not owning as much of those specific winners, feels the outflows as people rebalance away from active or just trim equity exposure.
That seems to be the dynamic they're anticipating. Year-end rebalancing after big cap-weighted gains often leads to outflows for broader active equity funds. Hashtag tag outro.
So wrapping this all up, this deep dive really shows T. Rowe Price in the middle of this incredibly complex balancing act. On one hand, they're investing heavily, aggressively really, in building a future business. The Goldman deal, ETFs, digital.
Big bets on the future.
But on the other hand, they're grappling with these persistent headwinds in their traditional active management business, leading to outflows and forcing them to be really tough on costs, all while the market environment itself is kind of working against their historical strengths.
I think the most critical takeaway, the synthesis point, is how much the success of their biggest bet, the Goldman partnership bringing private market alternatives into retirement plans, really depends on the regulators.
The target date series with alternatives.
Exactly. They clearly think that co-branded target date series could be revolutionary. But they admitted uptake will likely be slow until the Department of Labor, maybe the SEC, provides clearer rules, a safe harbor, saying it's okay to put these less liquid private assets into mainstream 401k type plans.
So the innovation is ready, the partnership is inked, but the regulatory green light is still pending.
Pretty much. The demand might be there, but the pathway needs clarification.
That really sets up a fascinating tension for the final thought, doesn't it? We have this extreme market concentration, which T. Rowe believes sets the stage for a huge alpha opportunity for active managers, eventually.
Right, the historical pattern.
But clients are feeling the pain of underperformance today, leading to outflows. And this potential solution, the hybrid public-private funds, is almost ready but waiting on regulation. So here's the question for you to think about. Given that immediate pain in active equity, how long will investors wait for that theoretical alpha opportunity before regulatory clarity potentially unlocks the floodgates to these private market alternatives, offering a different path to potentially higher returns?
How long does patience last when performance lags and a new option is waiting in the wings? That's the key question going forward.